You can eliminate catastrophic downside risk for zero out-of-pocket cost using a collar, but the price you pay is a hard cap on your upside profit. A covered call generates income, but a collar guarantees survival. Understanding when to switch from rent collection to insurance is the hallmark of a mature trader. Let's strip these strategies down to their core mechanics. A covered call is a neutral to bullish income strategy. A collar is a defensive strategy designed to protect existing gains. In a covered call, you own 100 shares of stock and sell one call option against it. The premium you collect is yours to keep, regardless of what the stock does. This premium acts as a buffer. If the stock drops slightly, the premium offsets the loss. However, if the stock crashes, you still own the shares and take the full loss beyond that buffer. Now, let's transform this into a collar. We take that covered call, but instead of keeping the premium as income, we use it to buy a protective put option. This structure has three parts: long stock, short call, and long put. The short call finances the long put. We often call this a financed protective put. The goal is often a zero-cost collar. This happens when the premium you receive from selling the call exactly covers the cost of buying the put. The trade-off is stark. With a covered call, you have uncapped downside risk. With a collar, you have a defined floor where you stop losing money, no matter how far the stock falls. However, that floor comes at a price. In a covered call, you keep the premium as profit. In a collar, you spent that money on insurance. Your net income is often zero. Let's look at the max loss profile. If the stock goes to zero, the covered call trader loses everything minus the premium. The collar trader only loses down to the put strike price. Now consider the upside. Both strategies cap your potential gains at the short call strike price. You are obligated to sell your shares if the stock rallies above that level. This creates a narrow profit zone for the collar. You only make money if the stock rises from its current price up to the short call strike. You are boxing price in. So which one should you choose? It comes down to your market outlook and your primary emotion: greed, income, or fear, protection. Choose the covered call if you are neutral to slightly bullish and volatility, IV, is high. High IV means expensive premiums, so you get paid more for selling the call. When IV is low, premiums are cheap. This is the perfect time for a collar. Buying the protective put is less expensive, making it easier to construct a cost-effective hedge. Consider the earnings play. If a company is reporting earnings soon, uncertainty is high. A collar protects you from a 20% drop, whereas a covered call buffer is too small to help. Another critical factor is your holding period. If you are holding a stock for years for dividends, a collar can be used temporarily during bear markets to lock in gains without selling shares. Remember the tax implications. With a collar, you avoid selling the stock, which defers capital gains tax. If you simply sold the stock to avoid a crash, you'd trigger a tax event. Beware of legging in. Some traders sell the call first, wait for a dip, then buy the put. This is dangerous. If the stock crashes before you buy the put, you have no protection. The safest execution is a combo order. You enter the short call and long put simultaneously as a single ticket. This ensures your pricing is locked in for both sides. Let's summarize the strike selection. For a covered call, we usually sell 30 delta calls. For a collar, we might sell a 30 delta call to fund a 20 delta put. If the stock rises and your call gets challenged, you can roll up and out. But with a collar, you must also manage the put. Rolling a collar involves 4 legs, meaning higher commissions and slippage. Ultimately, the covered call is an income generator for flat markets. The collar is a capital preservation tool for uncertain markets. Use the covered call to pay the bills. Use the collar to save the portfolio. Don't confuse the two. Trade smart, protect your capital, and see you next time.